Tom Lee reiterates on X today that inflation will cool dramatically in the second half of this year. It seems like that is continuing to be a reality. We had more inflation data this morning via PPI that showed just that. But what is ahead for our markets following Jerome Powell yesterday that gave us a little bit more of a hawking than we are used to? All of that and much more coming at you guys right now. PPI this morning on a headline basis came in at negative 0.2%. The expectation was positive 0.2%. So this was a dramatically less hot inflationary reading than we have been used to. If you don't know exactly what PPI is and why it's important, this is producer price index. CPI is consumer price index. Think of it like consumer price inflation and producer price inflation. Typically, when producer prices are going up, that leads to consumer prices going up because if you're a business and your input costs are rising, you tend to pass that cost on to consumers. So that's why PPI can be an important leading indicator to what CPI may do over the next coming months. Now, I think core PPI month over month was even more impressive, coming in at 0%. The expectation was 0.3%. So this was dramatically less hot than what we were expecting. This comes after yesterday's CPI was cooler than expected as well, and we had the Fed meeting. We did get a new summary of economic projections yesterday, as I mentioned, and I will go over as well here in this video. The Fed kept their estimate at 2.1% GDP for 2024, their unemployment rate stable at 4.0%, which is where we are right now. They did raise their PCE inflation expectations from 2.4 to 2.6% for headline and 2.6% up to 2.8% for core PCE inflation, which core PCE inflation is already 2.75%, so the Fed is not expecting any more progress on these projections for 2024. And the reason for that really is last year in the second half of 2023, PCE came in lower and lower and lower. So when you start to lapse that in the second half of this year, you would have to see some really good numbers to get more progress on that year over year number, which does make sense. But Jerome Powell yesterday reiterated that this was really a conservative estimate. And if we're at 2.7% PCE by the end of this year, that's still really good. That is according to Fed Jerome Powell and what he actually said. The Fed did raise their projected federal funds rate from 4.6% to 5.1%. Thus, we went from previously in March expecting 3 rate cuts, now to only pricing in 1 rate cut. But the markets are still disagreeing with the Fed and pricing in 2 rate cuts by December 18th with 44.4% odds. 3 rate cuts are priced at 22.7% odds, and only 1 cut is priced at 26.1% odds. Markets are currently pricing in the first Fed rate cut coming September 18th, a pause into the election, the meeting right around the election on November 7th, and then 1 more cut December 18th, 2024. And especially following today's PPI data and some other data, it looks like 2 cuts is probably the assumption of what we're going to get in 2024. We also had initial jobless claims that came in higher than expected, continuing this upward trajectory on initial jobless claims. The number came in today at 242,000. You were expecting around 228,000, so that was hotter than what Wall Street was expecting. Initial jobless claims are seen as a leading indicator to what could happen in the overall economy. And if you take a look at what's going on out there in the marketplace today, it's not a pretty picture for most stocks. The Russell 2000 is down over 1%, the NASDAQ up marginally, the S&P up marginally as well, around 0.1% apiece. And the Dow is down about 1/3 of 1%, with the Russell 2000 really taking it on the chin today. That's because you could make an argument that some of this data we're starting to get is pretty recessionary. Thus, you are also seeing the VIX up 1.5% at the time of recording this video. Now, it's pretty obvious initial jobless claims continuing to spike and go higher than expected is a bad sign for the labor market. But even PPI coming in lower than expected today, actually being negative on a headline basis, and core PPI coming in at 0% month over month, is not really a great sign for economic activity as well. Because what tends to happen during inflationary cycles is inflation tends to follow the business cycle, meaning that if you start to see a drop in inflation, presumably you're also seeing a drop in economic activity. And presumably, when inflation is running hot, so is the economy. So this data today from PPI could actually be signaling a weakening in the overall economy. And I think that's part of the reason why the markets have a little bit of nervousness today. You could also say Fed Jerome Powell yesterday being more hawkish than maybe what we were expecting is also having a negative impact on markets, because it looks more clear than ever. Fed Jerome Powell is waiting for some kind of actual material weakness to start cutting rates. And once you actually get weakness, it's too late. And it seems like, judging off of what Powell said yesterday, the better than expected CPI report did nothing to really change the Fed's outlook for rates this year, rate cuts, and all of your other data. Jerome Powell was asked pretty clearly, did the CPI report change your guys' projections on the dot plot? And Jerome Powell said, some people change them, some people don't. Again, reiterating that one good report is not something they're going to get too excited about. And at the same time, it seems likely that the Fed also had the PPI report that came out this morning yesterday, and they also seen that for, their dot plot estimates. So it really just looks like Fed doesn't care. They want to see some weakness before they start cutting rates. Here today in After Hours, we are going to get earnings from Adobe and Restoration Hardware. Adobe could be important for the AI trade. Markets still trying to figure out whether Adobe is going to be helped from AI or actually hurt from AI. Also worth mentioning, some of this strength today in markets is attributable to Broadcom, that's up 12% today, thus having a sympathy effect to Nvidia, also pushing up Nvidia 2.5%. But it's also worth mentioning that historically after stock splits, you do tend to get a period of weakness. We have not seen that yet with Nvidia, but don't be surprised if that does happen. Over on X, Carl with CNBC shared this from DRW that says Powell has no room to get hawkish. The unemployment rate is 0.6 off the cycle low. In the last 4 cycles omitting the pandemic, when the rate was up 0.6, momentum took over and the rate rose from that point on with a fury. So basically, if the unemployment rate goes from 3.4% to 4%, that's when you start to see an acceleration in joblessness. And if we blow this up to make it easier to see, it tends to follow a similar cycle with the unemployment rate going up and down until you do hit this inflection point, and then you really start to see the unemployment rate rocket higher from there. This is looking at 2001, 1990, 2007, and the present day. And this may eventually have a negative impact on markets as well if that consensus starts to grow towards maybe the Fed's actually going to give us a hard landing and not a soft landing. The Nasdaq today is hitting a new all-time high again, mainly because of Nvidia and other AI stocks doing well. When you actually look under the surface, almost 6% of stocks on our markets are falling under their 50-day moving average today. That's a pretty bad day for your average stock. You can see less than 41% of stocks are now trading above their 50-day moving average, which is off of the low of about 32% back here in mid-April, but well off the high of about 63% in mid-May. So at the same time, stocks have been chugging along and indexes have been hitting new all-time highs. It's actually a tell of two stories under the surface in our markets. TLT is up 1.31% today. Oil is up 0.5%, and the dollar is up 0.5% today, also putting some pressure on stocks. Option activity in the S&P 500 today, expiring by this Friday, is still on the negative side. You have volume of almost 57% puts and 43% calls. If you take a look at some large trades that are standing out according to this option scanner, you have 22 different trades totaling $3.92 million with a positive order value of 62%, so slightly on the positive side. Here today, the Fear and Greed Index is at 43, which is in fear territory. Market momentum is greed, stock price strength, extreme fear. What I highlighted with that 50, that chart of the percent of stocks above their 50-day moving average. Stock price breadth is extreme fear. Put and call options, extreme greed. Market volatility is neutral. Safe haven demand, extreme greed. And junk bond demand is fear. Here you can see today on StockTwits, sentiment around the S&P 500. Here I have the SPY pulled up, is extremely bearish today at 13. Yesterday, you were neutral at 45. Message volume today is high at 66. Yesterday, it was high at 61. And the participation ratio today is 53, which is considered normal. Brian Dietrich on X says, remember when the S&P 500 was up November, December, January, and February like 2024 was, the next 12 months have never been lower, higher 14 out of 14 times and up 17.4% on average. Again, there were many clues this year would be a good one for the bulls if you ignored what the economists and bow ties were telling you. 10 and 2-year yield curve inversion is still inverted 44 basis points, which is actually inverting a little bit more today. Yesterday and over the past couple of days, you were only inverted about 40 basis points. And it's actually when you start to uninvert on the yield curve inversion is when you tend to have problems. So the longer we stay uninverted, probably the better off for stocks. And Tom Lee over on X says, as we approach the midpoint of June, this is still true, sharing his own post from June 10th, so just a couple of days ago, where he wrote a lot of investors got shaken out of stocks in April, then sat out the 5% rally in May, then watching June, hoping for an entry. This is essentially FOMO, which he's basically saying stocks are likely to continue to do well here. After all, the biggest thing the markets care about is actually not the Fed, it's inflation. And your recent inflation readings have been coming in good. Now, one could argue today's PPI reading and the rise in initial jobless claims does kind of bring up the conversation around the economy slowing too much or too quickly, but it's a little premature for that to start to have a big impact on our markets. But that is why you are continuing to see this narrowing in markets where S&P is now green, but again, the average stock is not doing that well. You can actually see the S&P 500 on the RSI, stands for Relative Strength Index, shows you how overbought or oversold a stock is or an index. The whole S&P index is at 72.32, which is a little bit on the overbought side. The NASDAQ is a lot more overbought with an RSI rating of 77.01. So at the same time, things look good for a continued rally. Don't be surprised if you do get some form of pullback here within the next couple of weeks, especially heading into earnings, which will start up in the not so distant future. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already and you made it to the end of this video. Hopefully you learned something that you did not know before. Enjoy the rest of your day most importantly, and I will see you in the next one.